We broke the 200-day moving average yesterday. That's the first break since last April. So we've gone 214 days without a break of the 200-day moving average. So that's certainly worth noting, and certainly worth paying attention to. Is this something you should panic over? No. We've had breaks before, and again, we'll go through the data. Breaks in 200-day moving average aren't the end of the world, but they are certainly suggesting that there's a good bit more market weakness that potentially may linger here for a while.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and host Adam Taggart, welcoming you here at the end of the week for another weekly market recap featuring my good friend, the portfolio manager, Lance Roberts, Texas Ranger. How you doing, Lance?
I'm doing good. Texas Ranger was one of my favorite shows of all time growing up.
Well, hopefully you've heard the news. I don't want to be the one to break it to you, but Chuck Norris just passed away.
I have not heard.
I'm
And
sorry to break it to you, buddy.
no, that's sad. I mean, I know him personally, and I actually, when I was much younger in life, actually competed alongside him many, many, many decades ago. So,
Well, okay, now I can't not ask. Um, Tell us about it.
oh
What
no, no,
kind of
no,
guy was
just
Chuck Norris like?
yeah, no, he was in a different way. I was much younger, so he's in a different weight class, but we were in the same arenas. So I watched him fight up close and personal multiple times. So yeah, it's a great guy though, super nice.
I've heard super nice, and I mean, apparently a great fighter.
Oh,
Yes.
yeah. Absolutely. No, he was fantastic. And one of my big idols growing up, him, Bill Wallace, Superfoot Wallace, some other guys all from that general era. But
Yeah.
yeah, just a very sad. No, I'd not heard the news, so it is very sad though.
It is very sad. He apparently was like best buddies with Bruce Lee, like really in
Yeah,
real life.
yeah,
Yeah.
absolutely.
Yeah. Well, anyways, folks, sorry if I'm the one breaking the news to you here, but we lost a great in the action world, and I had a book of those Chuck Norris jokes, Lance, and they're all just fantastic.
Oh
And of
yeah, no,
course,
and the Chuck Norris jokes will live on. So
oh,
that
forever.
will
In
be
fact,
his
I'm sure there's a Chuck Norris joke about how eternal Chuck Norris jokes are.
exactly.
All right. Well, look, I was going to introduce you before I heard the news about Chuck Norris as the crude uh, portfolio manager, Lance Roberts.
That could be great.
Obviously because it's very appropriate, but also because there is a lot going on in the world of oil. We'll get to that in just a second, folks. We're going to keep today's market update pretty concise, pretty short, because if you're watching this when this is airing, I'm actually running the Thoughtful Money Spring Online Conference at the same time. It's running all day Saturday. If you didn't realize that and you want to join in, you still can. You can go buy your ticket and join the live event over at thoughtfulmoney.com/conference. And if you are watching this a day or two later and wishing you had seen the conference, don't worry. You can go to that exact same URL and buy a replay of the entire event. It will be available within a few hours after the conference being done tonight. It's an amazing event, folks. I won't go through the lineup right now. You'll find it at that URL, but 11 hours worth of amazing content. Absolutely the best value you'll find out there. But anyways, hope you come join us. All right, so Lance, uh, in our, almost every discussion we have, I take good
Mhm.
notes, and you say, look, news developments don't really matter to the markets up until the point they start affecting the market's projections for future earnings. We've been asking, since the Iran war started, how much of an issue is it market-wise? And you've said, really, not that much yet. Now, though, with the price of oil spiking, energy infrastructure getting hit, that's going to take likely years in some cases to rebuild, um, and now, no clear sense of when the war is ending. Are earnings expectations starting to get materially impacted by this?
Yeah, no. This was a chart put out this morning by LSEG, which is Refinitiv. And basically earnings estimates for through the end of this year are actually being ratcheted up.
Okay. Can you square that circle for the viewers?
Well, basically this is that when you talk about oil as a function of the market, it has a much bigger impact on international economies. So, right, so Brent crude's at 120, whatever it is. Those economies are much weaker than the United States. Obviously, their economies are much smaller. The U.S. has an economy, the largest economy in the world, and of course, the economy is where earnings come from, right? So more people out there buying, consuming, doing stuff in the economy. That's what drives earnings growth over time. And the next closest competitor economically speaking, is China, which is a third smaller than the US. Everybody else is just a blip on the radar. So higher oil prices over in those countries are certainly going to impact their consumption much more. So this is going to start to force more money back into the US. US assets over international assets will be the trade here. And again, think about oil prices. What do oil prices really do as much as, when you start talking about online advertising for like Google or Meta, right? It doesn't really impact their numbers much. But West Texas Intermediate crude is still below $100. Yes, it's higher. That's certainly feeding through the gas prices near term. But what markets are suggesting, look at the futures for West Texas Intermediate crude, they're back down into the $60 range by the end of this year. So what the markets are expecting, this will be a fairly short-lived event, and then we're going to get back to business of growing the economy.
Okay, I'm just going to have to ask these questions because I'm guessing a lot of
Sure,
viewers have
sure.
it, which is, all right, Lance. West Texas, yes, it's lower than Brent,
Mhm.
but it's still like almost 50% higher than it was just a couple months ago.
Absolutely.
Um, and hopefully this is short-lived, but we don't know. And even if it is, there'll be some impact from that, right? Yeah, oil prices might go down back down to 60 by the end of the year, but there's a lot of time between now and the end of the year. So A, that should impact demand to some extent this year, right?
Yes.
All things being even, people are spending more on gas and other things that get pushed up in price because of energy costs. So that'll diminish some U.S. spending, but also, you know, the material part of the U.S. economy is foreigners buying our stuff, and they're going to buy less of our stuff because they're getting hit even worse. So how
Right.
is this not a net negative to earnings? How are earnings actually going
It,
up? I can
it,
understand maybe you can argue that stock prices might be supported in the U.S. because capital might flow from there, but I'm talking just GDP here.
Right, right. And so again, mind you, this is analyst estimates, not mine. Okay, so let's
Okay,
just be
yeah.
clear about what the data is, right? This is what analysts are expecting through the end of this year. They tend to be wrong. I don't disagree with your premise. I mean, if oil price, and again, we showed this chart last week. If oil prices remained elevated for 4 months, you're talking about a market decline of roughly, somewhere between 15 and 20% theoretically, and that's going to be a function of all of a sudden that realization that forward earnings are being impacted. Those estimates are starting to come down materially. You take a look at, for instance, the first estimate GDP report kind of coming up here soon. The Atlanta Fed's at 2.3% growth, down from 2.7. Now that's still materially stronger than it was in Q4 because the government shutdown is over, but that's been weakening rather significantly as well. So the point is that your initial question was, so what are earnings doing? Earning estimates are going up. That's what Wall Street thinks. The risk is that doesn't happen. And what the market is betting on right now is that this event and with oil prices is going to be fairly short-lived. And if it is short-lived, it won't have that big of an impact on earnings. If it's much longer lived, that's going to be a very different story.
So how come we're not seeing more concern given the escalation this week of bombing of energy infrastructure in multiple countries around the Gulf, right? So that's stuff that can't be turned back online as soon as we decide traffic gets to go through the Strait of Hormuz again. That's stuff that's going to take, like I said, probably years in certain cases to rebuild, they're saying.
Right, but how much oil is, and again, we have to separate this out for a second, right? So you're talking about international versus domestic. So if heavy Brent crude and the Strait of Hormuz is bombed out and destroyed, how big of an impact does that have to the U.S. economy? Only about 1% of of oil supply to the U.S. comes through the Strait of Hormuz. It's a very, very small amount.
Hmm.
The U.S. now produces more oil than China and Russia combined. So one of the reasons you're not seeing West Texas Intermediate crude fly through the roof because of this is because we have much more production than we had back in 2008, or really
Hmm.
2007, before fracking became a thing. And we definitely have a tremendous amount more production than we had back in the 1970s, where the oil embargo was really problematic because we were so dependent on international oil supplies.
Yep.
So that's the reason, is that we're kind of in control of our oil prices to some small degree. Now remember, the futures market is a betting market. And there's two things that go on in the futures market. So first of all, high oil prices are great for producers, right? So producers are incented to go to market and sell supply now. Right?
Hmm.
I'm getting $100 a barrel. I'm going to go sell my supply now. But for traders, and a big chunk of the action that happens on the futures markets are just, they're not commercial hedgers. They're just speculators. That's a
Hmm.
very, very big chunk of the COTs. If you look at the Commitment of Traders report, a very large percentage of that is just the speculators in the market. And so they're just betting on events. And there's this like poly market for oil. So everybody's just betting on outcomes. I think, the shutdown of oil supplies is going to cause this problem. So I'm going to bid up, my contracts, going forward. So once that, and that's why when you see news like yesterday, there was a headline out yesterday that Israel said, that Iran's ability to produce missiles is now zero. Oil drop market, oil dropped very sharply for the day
Hmm.
and went negative. That's the speculators on the market just opening and closing positions. And
Yep.
that's why you get that kind of volatility. But, what's going to be important is, at the end of the day, how long does this last? And you're absolutely right. If oil prices stay where they are now, that's an extra $600 to $800 a year for the average consumer that's going to gasoline price, going to spend on gasoline and energy costs rather than buying, new apparel or buying a new computer or a new Apple, iPhone, whatever. So
Right,
there's
right.
definitely.
The boost we were looking forward to from the tax refunds is pretty much going to get gobbled up by that.
Exactly. And so that's going to certainly have an impact on, and look, that's what markets are pricing in right now to a large degree. We're seeing this decline in the markets right now. We took out the 200-day moving average yesterday, and we're below that today. So we've got a first real good critical break of the market trend going back to April of last year. So the market's certainly aware of the risk. Analysts may have not caught up with it yet, but the market's starting to price in kind of an expectation. And again, we've talked about this before. What markets look at on a daily basis is, headlines are one thing. They're looking at the E, right? And they're looking down
Yeah.
the road. They're saying, okay,
That's why I started by asking you about the E. Yeah.
exactly. So that E is very important. That forward projection of earnings is very, very important. It's still elevated right now, but I think what the markets are saying is that they don't think it's going to be that way. They're starting to reprice valuations now. And here, I actually did a chart on this morning as well. But one second. So here is a chart. This is valuations based on forward PE. So you can see that already PEs have dropped from 23 times earnings to 20 times earnings just over the last couple of weeks. So it's been a fairly sharp repricing of valuations. Again, the E's kind of staying stable, which means the price, we're down 5% from the peak right now. It's just kind of a normal correction, but because the E is staying stable right now, the valuation reduction is much larger because of the price drop. But if the E starts to drop, then these valuations are going to start to stabilize at some level in here, and we'll have to wait and see what happens.
Okay. Yeah. So I'm going to be very curious to watch this with you going forward. So you said a couple of things I wanted to dig into with you, and I'm just thinking about this out loud here. Not being an expert in the intricacies of the oil market, but Lance, as I understand, so yes, the U.S. is in better shape than a lot of other countries, that have to import a lot of their oil. And we have put ourselves in a better shape over recent years as we have, substantially increased production in this country. And of course, the current administration is the drill baby drill administration, and there's a lot of work they were doing even before we went to war here to to try to put tailwinds to U.S. energy production. That being said, uh, oil is a commodity, right? So
Mhm.
a barrel of oil, let's say a barrel of refined oil, is the same in making this up, Turkey as it is here, right?
That's right.
And
That's right.
so if you're in Europe, right, and all of a sudden the price of the oil that you're getting from the Gulf is going through the roof, right? You're going to then come over and start to buy oil from the US, right?
Mhm. Right.
And you're going to basically be willing to bid up the price of that barrel to, any price that's even just a little bit lower than what Brent is trading at, right?
Right.
So that arbitrage in theory should close, there should not be a big sustained gap for long between Brent and or WTI and Brent. There'll always be some difference, but they'll,
Yeah.
a big gap. Now there are things the U.S. can do to try to keep Brent capped, and we're already doing some of these things, like repealing the Jones Act. And if we wanted to, we could put tariffs on our oil, right? It's been floated this week, even though the administration has said, no, we're not going to do that. But there are things that we could do to kind of, keep our oil inside our shores and pay less for it going forward. But I think right now they're trying other things like the Jones Act, like I mentioned, like, releasing from the SPR. So, there's other things they're going to try to do to try to ameliorate the short-term pain of this. And of course, the administration is saying, hey, this is going to be a short war. Don't worry, folks. It's not going to last for that much longer. And when it's over, quote, oil prices are going to drop like a rock, right? Now, investors may or may not believe that. But one of the questions I just have there, though, is could you really have without those controls, like literally tariffing our oil against the rest of the world, wouldn't you expect WTI and Brent to get closer? Because again, oil's a commodity, and if it's selling for 120 on Brent, yeah, they're going to come buy at 90 from us and be willing to push that up to 119 because it's still cheaper than their 120 Brent.
That's right. And again, that spread is wider than normal right now, which is certainly something that we're paying attention to.
Yep.
And everything you just said is correct. Foreign producers can, so mostly, most foreign refiners refine heavy crude, which is North Sea oil, right? Versus light sweet crude, which is the US. So but they can switch from refining the heavy crude, to light sweet crude. They can do that, but it takes some time and effort to do that. So, part of this is again, how long is that going to last? And what's the accessibility? And again, if we're going to cap off exports or tariff our exports of oil, et cetera, that's a whole different dynamic. And I don't really have any foresight into what happens. There's a lot of stuff. We're all talking about things, talking about the Jones Act. That's basically what the Jones Act is. And the only reason I'm familiar with the Jones Act is because of my wife. Um, she set up marine bunkering for LNG here in Galveston and Houston, to bunker offshore ships with liquefied natural gas. Well, in order to bunker those ships, you have to use what's called a Jones Act compatible barge. And that means it has to be registered and flagged by the US in order to
Hmm.
transport oil. So this has been in place since I think 1940-ish. That act has
Right.
been around. It's
Yeah,
been a
and
long
sorry,
time.
but just to remind folks, the Jones
Yeah.
Act basically says you can't have a ship come into port that isn't a U.S. ship. Only
That's right.
U.S. ships can come into U.S. ports. And so this bunkering, as I understand it, correct me if I'm wrong, is you get a ship, it's got natural gas, it wants to bring it to U.S. port. It's got to stop before the port if it's not a U.S. ship.
Yeah.
And these approved barges have to come out and basically offshore the gas and bring it to the port.
That's correct. And so like what they were doing in Galveston was providing LNG to cruise ships, which are flagged, Norwegian cruise lines, et cetera.
Yep.
Carnival. Those are flagged outside the US. So yes, they have to stay offshore. They take the barge out, they fill it back up, come back into the shore. So it's very interesting. And that's, like I said, the only reason I know the Jones Act was a thing is because of that. It's been a very fascinating thing to watch. But yeah, they're talking about waiving that, which would potentially allow more movement of oil and gas, onshore and offshore here in the
Hmm.
U.S. So we'll see what happens. Again, there's so many moving parts. I would be, hard pressed to make a for sure bet. There's a lot of people on the internet right now going, oil's going to 150 or 200 or 300. Be careful with that because things can literally change overnight.
Right.
One policy change, one act change, one announcement, and you can certainly be caught on the short side of this market pretty quick.
So let me just pull on a few other things. This is my growing opinion, and folks, one guy's opinion, so don't hang your hat on this. But is two things. One, I find it hard to believe that there isn't going to be a higher premium placed on doing business in the Gulf going forward. Clearly, for sure, if this war, metastasizes into some long drawn out quagmire. But even if not, especially if the current Iranian regime is still in place, people are just going to be, once bitten, twice shy, right? They're going to be like, you know what? If I'm going to do business there, I'm going to demand, some sort of higher premium for it. And so it's going to be harder to, more expensive to insure the ships that go through there and all this stuff, right? Um, it's, and so I can see that having a net net, we're going to have more sustained oil prices going forward than we did before. Just my just my current assumption.
Sure.
Um, that said, and this might be unpopular to some, especially those who aren't in favor of what's going on right now over there. But I can see how this can actually be a net benefit in the end for the U.S. energy industry and other similar countries, Canada, Mexico, other net exporters, um, because countries that are currently heavily reliant on Persian Gulf oil, I don't even think this is opinion. I think it's actually starting to happen from what I'm reading,
Mhm.
are saying, hey, look, you know what? It was a little bit cheaper to buy from there, but I'm willing to pay a premium now to get oil from a quote unquote safer, country where there's not that kind of risk and some other benefits. So, for example, a lot of the Asian countries that we're buying from the Gulf, it's actually, I think it takes like, if you're Japan, it takes like 8 days, I think, to get a shipment of natural gas or oil from America, from Alaska, versus
Yep.
like 25 days from the Persian Gulf. So you're like, there are actually a number of other benefits we get. Now, maybe we're going to pay a little bit more than we were paying in the past, but we don't have to have the worry about the Gulf getting closed and our ships potentially getting blown up and all that type of stuff. And instead, we can get dependable supply quicker from a quote unquote ally of ours. So and it seems like we're working hard to ramp up our energy production to meet this. And the administration just announced, I think it was a few days ago, that they've already struck like $56 billion worth of new energy contracts with Indo-Pacific clients. I think specifically around this, they've been saying, look, the phone, since the war started, the phone's been ringing off the hook. These guys want to do deals left and right. So yeah, I said, some folks might not like this. And it sounds like sort of almost like war profiteering by America and some of these countries, but I just see that might be one of the longer term outcomes of this.
Yeah, and again, also think about too, countries like, you know, in the Middle East, like Qatar and Bahrain and others, where they go, you know what, we've been overly dependent on the Strait of Hormuz to move our oil. So they build a pipeline to the other side of the country where there's another port, right?
Yeah, I've
And
been
they
talking
just,
about that as well. That is happening.
yeah.
Has
And
happened, and I think they're now going to be doing even more of it. Yeah.
exactly. And so, it doesn't take, so this is my point about risk is that, be careful with making a bet that this is absolutely going to be the outcome is that, this is going to be the end game and oil prices are going to the moon because look, prices dictate action. And, as the saying goes, high prices are a cure for high prices. High gold prices are a cure for high gold prices. High oil prices are a cure for high oil prices because it always affects supply and demand. And when you have situations like this, countries that are dependent on oil will go, to your point, they'll go, maybe I need to find a different way to eliminate that risk in the future. Because look, Iran's not going away. We may, figure something out here and we may suppress them for a while, whatever it is, but the country's not going away. It's going to be there. So this threat's going to rise back up again. And this is probably a good call out for a lot of countries that have been thinking about alternative ways, moving pipelines, et cetera, to going, okay, you know what? We need to go ahead and do that now.
Right. So your point is the system is reflexive. Now, some things can move quickly. Like it's pretty easy if you're Japan to say, okay, I was going to buy this shipment next month from Iran. I'm now going to buy it from whoever. But some of this stuff also does take time. So I want to be realistic about this.
Yeah.
Pipelines don't, you can't put up a pipeline in a month. Those things take years. And as I said earlier, too, one of the other reasons why I think oil prices may be higher than we initially thought is some of the damage that's already been done, is non-material from what I can tell. And of course, this could worsen even further in terms of damaging of infrastructure over there that again could keep, oil from that part of the world priced a lot higher than it's been. But anyways, we'll see. Let me ask you this. You're based in Houston. What are you hearing from the oil community?
Oh, they're like having parties. So,
Okay.
you
So,
know,
so is this truly like a big bonanza for the oil
oh
companies
yeah, yeah. No, I mean,
and gas?
especially when you start getting, spreads widening out, this is huge for producers. So, they'll make a lot of money here. But again, it won't last long. As these things don't last long, and we've been through booms and busts in oil prices for the last ever since I was a kid. And so one thing that drillers in Houston have gotten a lot more smart about is realizing that these periods don't last for a very long time. So they certainly take advantage of it while it lasts. But what you're not seeing, and this is a good example of this, oil prices are up, but you're not seeing rig counts flying through the roof right now. So they're not going down and throwing out a whole bunch of new rigs right now based on this action, this price movement, because this is something that's not sustainable long term.
Okay. So we've been talking about, well, a little more context. Near the end of last year, you know, we were talking about, hey, the oil sector is actually looking like it could be poised for the return to some sort of bull market. And then the oil prices, or sorry, the oil companies started actually doing really well. This is all pre-war,
Right.
to the point where you were saying, hey, I like the industry, but these things are way short-term overbought.
Yep.
Now we've had the war come. They're making apparently money hand over fist right now, although to your point, it might not be forever. Are they still looking crazy overbought, or is these higher oil prices, at least in the near term, kind of riding to the rescue valuation wise?
Well, technically, they're very overbought, right? I mean,
Okay.
just they've had huge price moves ever since the beginning of the year. And this was that whole reflation trade. So it was interesting. If you take a look at a chart of, say, like ExxonMobil, had a huge move in January and February. Went from like 115, 116 to 140. So it had this huge move. Really, since then, it's making a new high today. But really, since the war started, it's pretty much kind of been traveling sideways. And over the last, week or so, it's kind of moved back up. But it's just consolidating here for a bit. But fundamentally, these are good companies. But this is a company that its sales are basically flat. You don't see huge spikes in sales over the years. In fact, sales have actually been declining over the last 4 or 5 years on revenue. EPS is basically flat and it trades at 24 times earnings. So and it's got a PEG ratio of almost two and a price to sales of two. So it's not cheap. It's a great company, nothing wrong with it at all. And if you're long ExxonMobil, it doesn't mean go sell it, but just technically it's very overbought. Fundamentally, it's probably fairly valued.
Okay. Um, well, let me ask you this, not just your opinion, but what are you guys doing at RIA in response to this, if anything? Are you just letting what you had ride? Are you adding? Are you trimming?
Well, no, we trimmed a couple of weeks ago. Obviously, kind of before we got into this whole mess of what was going on, markets were already starting to show a little bit, and we
Yeah.
wrote that
So
article about
that was back then when you were saying, hey, they're
yeah,
short-term overbought.
yeah. And
Okay,
so
but
we reduced
post-war,
about
are you making any difference, any
yeah,
changes?
yeah. So we made a bunch of adjustments before all this occurred. So we've pretty much weathered this pretty well. But we're still holding our energy positions right now. They're doing great. They're obviously being a buffer to the portfolio. We've reduced some of the other positions in the portfolio that were being more of a net drag. So, we're just kind of balancing this right now. Now, because of what's happening technically, there's some breakdowns that are occurring now that warrant raising a bit more cash, but we're not going to do that now. We're going to wait for a bit of a rally here and then sell into that and raise a bit more cash.
Okay, sorry. When you say breakdowns, you're not talking about energy stocks, are you? You're talking about the
No,
general
no,
market?
market in general.
Yeah. Okay.
Yeah,
And so why don't we go there? Why don't you pull up the chart of the S&P if you can? But let's talk about what's going on there because you mentioned we broke through the 200-day moving average, which was the big line that you guys were looking at.
yep.
So I presume, don't want to put words in your mouth, but I think I know you well enough, Lance. I presume this is really like a key moment for the market here to determine whether or not the market can regain the 200-day moving average. But I presume if it closes below here for enough days, you're going to start getting real worried about how far it could drop.
Well, yeah. So this is kind of a really interesting point in time, right? Um, the big decision that you have to figure out is whether this break of the 200-day moving average is a brief break or a sustained break. And I'm gonna show you some tables here in just a second to go along with this analysis. In fact, this is will be Bundy's article. So If you go to our website, realinvestmentadvice.com, on Monday, I'm going to have a full article on the breaks, the 200-day moving averages, all the history, all kinds of stuff. So we'll have lots of analysis for you on Monday. But we broke the 200-day moving average yesterday. That's the first break since last April. So we've gone 214 days without a break of the 200-day moving average. So that's certainly worth noting, and certainly worth paying attention to. Is this something you should panic over? No. We've had breaks before, and again, we'll go through the data. Breaks of the 200-day moving average aren't the end of the world, but they are certainly suggesting that there's a good bit more market weakness that potentially may linger here for a while. Now, markets are oversold on a real short-term basis. Technically, we're very oversold. Sentiment-wise, we're getting very bearish. Those are good. Those typically are good supports for a reflexive rally in the market. So you can see this market rally back above the 200-day moving average next week. Get back to 67.20, 67.50 in there. That wouldn't be surprising at all. Any piece of good news coming out over the weekend in regards to Iran will certainly spur that type of activity. So you get any type of rally, I would definitely be selling into that, raising a bit of cash. As we talked about last week, there's just a huge amount of trap long sitting between about 67.50 and 6900 right now. In other words, those were people that were buying those previous support levels that are now trapped and they're losing money. So any
Right.
rally back to that
They're
level,
begging, please
selling.
just get back to that level and I'll
Yeah,
sell.
exactly. It's
Yeah.
like if you'll just get me back there, I'll sell, I'll get I'll never invest in it again. And we're seeing this really across markets. You're seeing the same type of action, not just in stocks. You're seeing it in precious metals. You're seeing it in cryptocurrency. You're seeing it in a lot emerging markets and international. We're seeing all these kind of breakdowns simultaneously across market environments. About the only thing doing well right now is energy, just because of what's going on with oil prices. But everything else, there's a lot of breakdowns kind of occurring across markets that's worth paying attention to. So, um, so that's kind of where we are now. Now, this is these colored lines in the background. This is what's called a Fibonacci retracement. And Fibonacci is famous mathematician, and he discovered what was called this golden ratio. And these ratios are found everywhere in the world. The number of sunflower seeds in a
Right.
sunflower, the length of
Seashell spirals,
your elbow,
galaxies, yeah,
everything,
everywhere.
right? This shows up everywhere. So it shows up as mathematics. So it shows up in the markets as well. And we've done a complete retracement now back to the lows of last November. So we've done 100% retracement. So there's going to be good support right here. There's a lot of people watching the same data. So I wouldn't be surprised. Now, today in particular, on Friday, when you and I are talking, it's options expiration day. It's a huge option expiration. So the volatility we have today, I would kind of bypass this a little bit until we get into next week because people are having to close out options, set new options, those type of new contracts. So that's causing a lot of market volatility today. So kind of ignore today what happens. Let's look at this on Monday, Tuesday next week and see where we are. But let's talk a little bit about history because this is I don't want anybody to go panicking off here to, being like Lance said, it's breaking the 200-day moving average. We're all going to crash and die. So let me share these. I got a few tables to share with you. Now this will be so I'll have more commentary on these tables on Monday. I built these for Monday's article that I'm working on right now. But this is a table of sustained breaks below the 200-day moving average. So going back to the beginning of the century. Does that make you feel old, Adam?
It does.
Going back to the beginning of the century, there's been 7 sustained breaks below the 200-day moving average. Now, what's important is that 2 of those were the dot-com crash and the financial crisis. So obviously, there's risk there. And, but those had some special events that go along with them. And we can certainly look for some analogies that we have today, financial crisis, subprime loans. Today we've got private credit, very different issues. But, we can point to things and say, hey, there's some risk outside of just the Iran crisis. EU debt crisis, China oil shock, Q4 rate scare, COVID crash, inflation cycle. We broke the 200-day moving average on a sustained base. In other words, it went below the 200-day moving average and it stayed that way for a period of time. Now, what's important is that in 9 months, though, 9 months later, you were back to positive. The average drawdown was about 5 to 6% in total. Your median on a sustained basis was 4 to 5% of a drawdown basis, and then you were back positive in 9 months.
Okay. Hey, Lance, sorry to interrupt, but what's below the 200 DMA for a sustained level? Weeks, months?
Just did that. Yeah, it remains there for more than 3 weeks.
More than 3 weeks. Okay, got it.
I guess I should have noted that, but there you go. Went the wrong way. Sorry. So this is well, if my there we go. So if you take a look outside of that, there's been five other brief breaks of the 200-day moving average. And of those, the market was actually positive 3 months later. So this is why it's a brief break, right? You know, 9 months later for sustained break, 3 months later, you're back to being positive in the S&P 500 after those. So all combined, and again, this is why it's important to try to figure out where you are. If you go sell this break of the 200-day moving average, and this is a short-lived event, you potentially run the risk of giving up a lot of gains over the next few months. If it's not, if this is a sustained break, and I don't know which one it is yet, we're gonna have to wade through this together, then that's obviously going to have a weaker outcome for earnings and for markets for the rest of this year. So this is why it's so important. Don't knee-jerk react to this until we get a better handle on what we're actually dealing with.
Okay. And this might be a little too simplistic, but does that mean you're sort of you get it out for 3 weeks, and if it hasn't recovered, then you're like, okay, I got to start really trimming because it looks like this is going to be a sustained cycle?
Um, well, I wouldn't say you just gut it out and don't do anything. But I think it's something. This is where again on rallies you reduce risk. You take a look at what's working, what's not working, rebalance accordingly, trim back on areas that are really under a lot of pressure. It doesn't mean you can't buy these things back later, but
Hmm.
just take some of that risk off the table
Okay.
until we can figure this out. And look, even if you went and sold a bunch of stuff today and then tomorrow we rally back above the 200-day moving average and everything is fine, so what, right? You just get back in.
Right.
This is the mistake that people make, though, is like, oh, I got out, I can't get back in now, and the market
Right.
runs away
Yeah.
from them. But there's nothing that says, anything, kind of like that. So this is where, so I went back and I looked at kind of indicators, technical indicators that would identify a sustained break versus a brief break. And so, like you look at the dot-com crisis and the great financial crisis, the 200-day moving average was flat to declining. The weekly MACD was negative. The RSI was in a very low range. The bears were below 45%. Breadth was below 40%. The 50 and 200-day moving average were converging. So those all lined up. So you had 6 of 6 that said that was a sustained break below the 200-day moving average. Same for inflation. This was 2022 with the inflation risk, right? You had all 6. We're currently only have 4 of the 6 really. And so we're kind of in that area maybe for a sustained break below 200-day moving average, but it's certainly not as definitive as it was, kind of previously. But again, it's also a function of time. These other kind of factors may start to, if we keep staying below the 200-day moving average for the next couple of weeks, we're going to start ticking off more of these check boxes.
Yeah. Okay. And I agree with all the steps people could and maybe should be taking right now. But again, to my question, if we're still below the 200-day moving average in 3 weeks, will RIA then take a new set of actions?
No, no, we'll take actions before we get there. We're not going to wait for 3 weeks and go, okay, now it's a sustained break. So, now we're going to do this. We're, like I said, markets don't go straight up and they don't go straight down. You just had a nice little rally last week to let you sell into. Actually, a little bump earlier this week you could have
Yep.
sold some into. Markets are going to do that. Markets are going to give you these reflexive rallies that you can reduce risk into. And I certainly encourage you doing that until we get through this period. And again, just because you sell here doesn't mean you can't turn
You
right
can't
over
give up.
and
Yeah.
stuff back.
Let me just ask my question one other way. So,
Okay.
yes, you were going to do things now to position for a potential sustained
Yeah.
thing. Are you going to take all those steps now and then just undo them if we're above it, if we get above it in the near term? Or are you going to do some steps now and then when you're like, okay, we've been here for 3 weeks, I'm now more, confident it's the sustained, and then I'm going to do the rest of my stuff.
So no, like let's just lay out a hypothetical, kind of an example,
Yeah.
right? So let's say that next week the market rallies back above the 200-day moving average and it gets to around 65, 66, 6,700 on the S&P, like it's possible. We're going to sell into that. So we'll probably take, just as a function, we've got 20, 25 positions in our portfolio. We'll probably go and trim 10, 12, 14 of them back by a quarter basis point, reduce them back to target weight, maybe slightly underweight them relative to their target weights in the portfolio. So we'll raise 5, 6, 7% cash, whatever comes out of that. Then the market comes back down, tests the 200-day moving average, and then rallies back up, breaks above 6,700, moves back into that target range. And we now have a confirmed test of support. We're now back in a more bullish trend. We see sentiment turning positive. We see, indicators turning positive. The narrative is behind us now. Then
Yeah.
we'll start adding back to our portfolio, right?
That's your all clear there. Got it.
That's all
Yep.
clear. So, but let's assume that we have this rally, we sell some into it, we come back down, we take out the 200-day moving average again, and then we'll be back to oversold. And so when the market rallies again, we'll go back in and do exactly the same thing, raise some more cash, reduce our risk, those type of things, and then figure out what the market's going to do next. But eventually the market is going to bottom. You're going to start getting positive buy signals. You're going to get negative sentiment that's at levels that are normally consistent with market bottoms. And then regardless of what else is going on, we're going to start buying stocks back into the portfolio.
All right. So again, more questions. So in the scenario you mentioned where it pops above
Mhm.
does that reset the clock on the 200-day moving average
Yeah, it
issue?
does.
Okay. All right.
Because at that point, it's a brief break.
Yep. Okay. So then let me say this. So whether it goes up and then back down or whether it just stays down,
Mhm.
when you've been down for 3 weeks, does that give you is that a signal that you're going to do even more substantial things like,
Yes,
okay, we're going to ratchet down our equity exposure by 25%, right? You've got those level. I'm just
sure.
making that up, but once it's confirmed,
Right.
is there another playbook that comes into play?
Well, no, it'll be a continuation of the same playbook. So like we've already reduced our portfolio from being overweight equities to underweight equities, and we'll continue to do that more. So if 3 weeks from now we're still where we are churning around or we're breaking lower, then yeah, we're going to raise more cash
Okay.
and
All
we're
right.
going to get more defensive. So yeah, I mean, it's just a function now of just letting the market really kind of dictate the next sets of actions.
Got it. Yeah. All right. So, folks, Lance and I like to think that these weekly recap videos are required viewing, essential viewing, but I think they're going to be particularly so over the next couple of weeks. So hopefully you keep joining us as we will track this in real time week after week to see what's going on here.
Yeah.
All right, Lance. So, like I said, we're going to keep this a little bit shorter than normal, even though we're already 45 minutes in. Um, Private credit. Um, I've not had a lot of chance this week to follow the headlines because I've been preparing for the conference. Although in talking with a lot of the conference faculty, private credit concerns are certainly it's a very common theme here. What's been happening in this space? Do the hits continue coming here, or is there any reason for hope here?
Oh, no, there's certainly reasons for hope. First of all, a lot of this is really getting overblown into some degree because what everybody's focusing on is they're focusing on the funds that are gating liquidations. And this is funny, actually, because when you invest in private equity or private credit, when you do that, you get paid an illiquidity premium for investing in those funds. And the reason you get paid an illiquidity premium is because let's say that Adam wants to invest in my company. And we'll just use a really simple example of this. So Adam's going to loan me money, private credit, to my company. He says, Lance, I'm going to loan you this money for 7 years. Here's the interest rate, and you need to pay me back in 7 years. Well, so the market starts to get a little bit dicey. And for that private loan that he's going to give me for 7 years, I'm going to give Adam a premium over liquid treasury rate. So I'm going to pay him 7% on his money or 8 or 9% on his money versus what I could go borrow at the bank. But I'm doing that because he's giving me better terms on payback options, whatever it is, right? There's multiple reasons people do this. So he loans me this money and he says, okay, we're good. So I've got the money, he's got the loan, and we're all good. Now Adam starts hearing all these concerns about private credit. There's these issues with buy now, pay later, whatever it is. And Adam goes, man, I'm not so sure that what's going on with my loan. So he calls me up and says, Lance, I'd like my loan back. And I was like, hey, I got 7 years on this note. I'm not paying you back today, right? That's why I'm paying you a higher rate is because you've given me
Right.
terms for 7 years. So this is the funny thing about all these investors running around with their hair on fire. They were all investing in private credit thinking they had liquidity, that I'm going to get paid this exceptional rate of return. I'm going to have this lower volatility asset, and I can get my money back at any time I want. Well, you can't do that because these private credit companies have loaned money to other businesses that have a time period to pay those loans back. And it doesn't matter what happens in between, as long as they're making payments, they can repaper options, whatever it
Right.
is. That's the risk you took. You don't get liquidity in private credit. And you whining about it now, and of course, this is why these funds have gating features, is to stop the run on the bank so they don't have to go liquidate. They don't have to go start calling all of their investments and saying, you've got to give me the money back now,
Right.
destroying those businesses because you want your money back. So, so that's the funny part about all this is that you get what you ask for, and this is what you ask for. And,
Yeah.
now, so having said all that, look, the private credit is an issue, but there's a huge difference between the private credit markets and subprime. Subprime was a issue that focused on the individual, right? These were people that didn't have any money to start with. We were giving them loans for houses they couldn't afford with no verification, no assets or anything else to afford the house. And so we gave them loans they couldn't pay. So but it wasn't just those. We then took those subprime loans and we created other loans off those subprime loans called derivatives, of which we took those derivatives and then derivatives of those derivatives and derivatives of derivatives of those derivatives down the road. And so we took one loan and we magnified that thousands of times across the market. And we were selling these things in all types of tranches and structures and option structures, everything else. So when it blew up, that just rattled the banking industry because they were so heavily tied into this. The banking industry is not that heavily leveraged into private credit. This is mostly private credit funds that loan money out to private businesses. There is some leverage from the banks, but it's a very small amount relative to what you saw in the subprime crisis.
Okay. And that's something that I haven't seen the data I'd like to see on. Sounds like maybe you've had access to it, is um, yes, the regulated banks aren't making private credit loans,
Right.
but I believe the regulated banks are making loans to the
Yeah.
private credit lenders, right?
Yes.
And
They are
so,
providing leverage.
pardon me?
Yes, they're providing the private credit lenders leverage.
Right, right. So they are, indirectly connected, right? Private credit company makes a bunch of crappy loans. They go under, they can't repay the loans back to the actual regulated
Right.
bank. But you're saying I mean, well, you said it's not as exposed. The banks aren't exposed as they were during the subprime market. That may be very true. I totally am willing to believe that. The question is it a massive delta or is it a smaller
It's
delta?
a
I don't
pretty
know.
significant no, it's a pretty significant delta, and the reason is that you don't have the derivatives of the derivatives of the derivatives of the derivatives on publicly traded. Remember, so if I have a publicly traded asset, I can create all kinds of contracts against it. Private
Right.
credit is not publicly traded,
Hmm.
right? So in order for me, and look, there are ways that you can trade off of private credit. So there are things that can be done, but it's much more difficult to create derivatives of derivatives of derivatives off something that's not liquid and publicly traded.
Got it.
So you
Okay.
don't have that kind of exposure like we had back in the subprime.
Okay. And I just want to note a couple things about this. So, one of the terms that we've seen a lot in the private credit discussion so far has been these BDCs, these business
Mhm.
development companies,
Yep.
or corporations. And uh, Stephen Bavaria, who I've had on the channel a couple of times, who, is real focused on income investing, he has them as part of his portfolio.
Mhm.
And I just want to remind, and I reached out to Stephen to see how things were going. And he said, yeah, the prices of some of my BDCs have gotten hit fairly substantially. But he said, I'm not really that worried about it. And again, the reason why is, he talks about, one, when you build an income portfolio, what you care about is your income, right? So as long as the income's coming in, that's really what you care about in the here and now.
I'm
But
going
he
to push
also
back on that in a second, but go ahead.
Okay. But he also talks about the difference between credit investing and equity investing. And when you're dealing with credit investing, you're really just worried about kind of existential risk, right? As long as this company is around, it's going to make its debt payments. It's only if the company really like starts to, fall into bankruptcy. And even if it does, you're going to be ahead of the equity holders in it. So you're likely to still get something back. When you're an equity holder, there's all sorts of other things that come into the mix, right? So, he's basically like, look, you've got all the CEOs of all these companies that took out these loans working in your interests. They're trying to stay alive. They want to stay alive. They want to get their paychecks. They want to eventually, get the company back to health and get a bonus. So, he's like, as long as these things don't die, you weather the storm, you're still getting paid all along the way. And then eventually, when the cycle turns, they'll be fine again. And hopefully you won't have too many losses in your portfolio. So he's not saying that there isn't any risk there, but you're only dealing with the existential risk versus all the other risk stack that you get, with
Yeah, no, no, he's absolutely right. And the thing I said I was going to push back on income investing is that all sounds fine and dandy until you lose 50% of your money. And which happens all the time. And importantly, it's all fine and dandy that you're getting paid 8, 9, 10% on some investment. It's like, oh, this I own this because I get 10% a year on it. And then you lose half your money, and then the company says, "Oh yeah, we're not going to pay our dividend anymore because we're financially in trouble now." So now you lost 50% of your money and your dividend. So when people tell you is like, "Oh, just buy and
well,
hold and just work, just collect the dividend," that doesn't work well during bear markets. And if
well,
we're
that's the
going into
existential risk is
yeah, yeah, if
these
we're going
companies
into
go
a
out.
real bear market, yeah, look, the bottom line is if you lose your capital, you're out of the game. So regardless of what your investment structure is, protection of capital always comes first. I was talking about this last week on the radio show, which is, stop being greedy. When the market goes up, when you get 100% return on the stock, you sell half. You take all your principal out, you stick that in cash. And then, if the
Right.
thing goes to 50 or 100 and you triple, quadruple, quintuple your money, fantastic. But go put your capital back in the bank account, right? Because if you lose that, you got nothing left over. But people don't do that because they're all like, oh, but I've doubled my money. What if it doubles again? And what if it doubles again? Well, I can't tell you how many people I've seen watch turn a really, well positioned, very profitable transaction into negative numbers by not wanting to sell something.
Yeah, exactly. And, I'm sure we've got a lot of people who've done that on a lot of different assets we can think of.
Yeah,
But so I agree with everything you said. I just want to return back to Stephen for a second. And
sure,
folks,
sure.
I'm not promoting necessarily his approach here, although I think it's definitely a very interesting one to consider. So with BDCs specifically, he's buying these managed ETFs,
Mhm.
right? Like the Apollo, BDC ETFs. So he's basically saying, look, yeah, I'm not just going out there and buying some random BDC on my own. Like I am leveraging the top managers in this space. And so A, I'm diversifying because BDCs are only a slice of my portfolio. B, I'm investing in this, broad base of BDCs that a top high performing manager who can, basically demand the best terms in the marketplace, is getting. So he's got multiple levels of diversification there. And again, to your point about capital preservation, Lance, his whole thing is takes into account the historic default rates and all this stuff.
Mhm. Yep.
And it is quite low, right? At least in the way in which he builds it. So, anyways, I mentioned that because I just want folks to keep it in mind. I've been getting a lot of questions about, hey, how's Stephen Bavera's approach doing? But also to Jan Van Eck, who comes on to give a quarterly update on this channel every quarter. Last quarter, he was saying that he thought BDCs were looking a bit vulnerable. Um, he just reached out to schedule his next quarterly outlook update he's going to do for us, I think in like 2 weeks. But he's saying, hey, I turned out to be kind of right, but I'm now seeing some really attractive valuations in the BDCs when you look
Mhm.
at kind of their odds for survival versus what they're being priced at right now. So he'll talk more
Absolutely.
directly about that when he comes on.
Yeah, no, and we just actually launched a tracking model for BDCs on SimpleVisor just like 3, 4, 5 weeks ago for the same reason. Because we're looking for there are some very attractive opportunities now creeping up. One I like a lot is Main Street Capital. But there's again, this is the baby out with the bathwater, is that when you start talking about a very small slice of the pie, private credit, they're like, okay, well, private credit's going to go bankrupt and all these BDCs are going to go bankrupt along with them. The funds, Blackstone and BlackRock and these other big private credit funds, they're not going bankrupt, right? They may write off two or three or four of their loans eventually, whatever happens. But the ones that are at risk of going away, and we talked about this before, is when people come to you and they're pitching a private credit fund or whatever it
Right.
is, you know, always asked them, was like, well, why are you giving me this opportunity? Why
It's
is
the
it?
second, third, fourth, whatever
Yeah,
tier. Yeah.
exactly. Those are the worst deals. So there's going to be a lot of those private credit funds that do go away. They will completely evaporate. But most of these big private credit funds, they're going to be fine. They'll write off a few of their investments, they'll move on, and it'll be good. And same thing for these BDCs. They've gotten beaten up in price. A lot of these are down. I mean, like Golub Capital, like I was just showing you a second ago, or just talking about, that's gone from 20 $20 to 12 like in the last couple of weeks. So,
Right.
there's just, they've had, big compression in price. In fact, that BDC is trading as the lowest level it's been at since 2010. So,
Yeah. So there may be some great
yeah.
opportunities here in the end, right? And this, again, this is most people are familiar with equity investing, but with credit investing, a big part of it is just math, right? I mean, like, for example, for that company you just mentioned, like essentially half of their loan book would have to go bad.
So yeah, this is a company that I like a lot. This is Main Street Capital. Just to go to show you this is a monthly chart. So this goes back to 2009. So if you've just bought Main Street Capital, it's just been a steady grow over time. It's had some big drawdowns. It lost 50% of its value back in 2020. So it can certainly lose money. But, this has just been kind of a real steady grower, pays out a decent dividend, and, you just kind of collect it over time. But you zoom in short term. So this is where we are right now, right? This is what's going on lately. You look at this chart, it's like, oh my God, right? Private credit's blowing up, it's all going away. So Main Street's about to go away. This is what I'm talking about. You're getting some very decent discounts on these positions that long term are typically good buying opportunities.
So let me just ask you one last question about private credit, and then we'll start
Sure.
wrapping things up. So in the preparation for this weekend's conference, um, the point was raised that yes, there's some potential exposures we talked about in the public banking system to the private credit lenders as they're getting weakened here, um, but also as investors are getting gated, right? So you've got private credit investments that you're now worried about,
Correct.
right? But you can't get your money out,
That's right.
right? So now you're kind of freaking out as an investor, right? So
You were
what do you
paid, but
do?
remember, but real quick, remember, you were paid for that
No,
illiquidity.
no, no, totally.
Yeah.
Right, I get it. I get it. But you're freaking out now, right?
Sure.
Like so what do you do? Well, you're like, well, geez, I'm feeling under pressure here. I got to raise liquidity. So what are you going to sell? You're going to
Everything
sell
else.
your publicly traded
Yep.
assets, right? So the question here is this sort of contagion, is there danger of contagion spilling over into the public markets? Not necessarily because the loans have gone bad yet, but these freaking out investors are just selling what they can.
Yeah. Well, first of all, you know, it's a nice theory in general, right? But I don't know if it really holds a lot of water. And the only reason I say this is that most people, and because again, look, these private credit funds, private equity funds, these aren't really open to retail investors. So this really isn't your mom and pop that
Sure.
put 25 grand. There's there's
Right.
there's some of those.
Right.
Let me be clear. There are some of those funds that are out
Some,
there
yeah.
thinking
But maybe this is
$25.
worse because it's the bigger institutions.
Yeah.
They've got more to sell.
Yeah, but most of these bigger funds, they've got $5 million minimums, they got $1 million minimums, whatever it is. And so people that are investing in that chunk of capital, when that gets gated, they're not really freaking out because they have tons of capital invested elsewhere. This is a very small asset in a lot of cases relative to their total portfolio allocation. Take a look at high net worth investors in general. Only about 20% of their total net worth is in private investments. So, and this is one, maybe they've got one private credit, maybe they've got two private equities or whatever else. So it's a very small sliver of the pie. So I doubt that there's a
Lance,
lot of pressure.
we just launched your video again.
I don't know why that's going on. So, but this is a small piece of their overall pie. So, it's unlikely that that group of investors are out selling everything else. I think this is more of a lot of retail investors that were buying heavily into the market earlier this year. They were chasing the reflation trade. They were buying emerging markets and international, and they were buying, everything else. And all those have now broken because the rally in the dollar has undermined all the anti-dollar trades. The inflation trade was, or this kind of reflation trade has gone under pressure now because of high oil prices. So maybe we won't have reflation. Maybe we'll have recession instead. So that's all getting impacted. So I think you're just seeing a lot of that selling more systemic than anything else. You're taking out support levels. That's triggering a lot of automated selling. And we're seeing that kind of pressure on the markets. Because again, if you take a look at volatility, we had a spike in volatility, but that's mostly returned back to normal. So we're not seeing, big volume down days. We're not seeing big spikes in volatility. This more seems more like a more normal kind of orderly 5, 6, 7% correction after that 35% advance we saw from last April.
Okay. All right. Well, look, I'm going to start wrapping it up here. So
Sure.
trades, Lance, have you guys made any trades since last week?
Not this week, probably next week, I would
Okay.
guess.
And when you say probably next week, are you assuming, is that sort of assuming that, hey, if we stay below the 200-day moving average, there's stuff we're going to do?
That, or I think I think we're oversold enough. We're going to get a bounce next week, maybe for a couple of days, 2, 3
And then
days.
you'll sell into that strength as you told
Selling
us
the
you would.
strength. Yeah.
Yeah. Okay. All right. Quick rant here. So Lance, you and I, we've talked at times about the social turn here in the West, not just in the U.S.,
Mhm.
but towards socialism, right? We're seeing more and more uh, political figures, advocating it, and obviously we've had the election of Zoran Mandami in New York City, who ran on a basically, I guess I think he would say Democrat socialist program, but it seems pretty socialist, much more on the
Right.
socialist side. Um, we have talked about the risks of that, right? And this is something that happens in historical cycles, right? Is that enough time transpires between a generation that dealt with a problem that over time, they get old, they start to die off. The younger generations didn't live through that, and so they don't have those lessons ingrained in them. And in many ways, they sort of return to this is why history rhymes, right? Repeats and rhymes.
Right.
Um, and they start entertaining ideas and think, well, maybe that really wasn't such a bad idea. Maybe it was just poorly applied, and let's try to do it better this time, right?
Right.
So those of us who have the gray hairs or the lack of hairs, as you and I have, I think we sort of understand the dangers of socialism better than a lot of the younger generation that's turning to this. And again, I have said I understand why the younger generation is turning to sort of the siren song of socialism, because if you feel like you're getting screwed by the system in general, why not vote, even if the guy's going to screw you, vote for the guy who's promising you free stuff versus the guy who's not, right?
Right.
But there was a really interesting development in New York, and Lance, you may have seen this, but Governor Kathy Hochul of New York,
Mhm.
um, she she made a really interesting statement this week, which I'm gonna play in just a minute on a video clip here. Um, but some context for this. So back in 2022, um, she was this is on camera. You can find it on the internet, folks. She was basically, making a partisan political statement. She's a Democrat, and she was basically sort of telling, wealthy Republican New Yorkers, like, we don't need you here, right? Like, if you don't think the way that we do, we don't want you in the state. So, head on down to Florida, folks. We don't need you here. Well, fast forward to 2026, when enough both rich tax refugees have left the state, and a lot of companies have left the state, that the state's tax base is getting eroded. And now she's singing a very different tune. And let me very quickly just play this clip here for you.
And Zeldin and Molinaro, just jump on a bus and head down to Florida where you belong, okay? Get out of town. Get out of town. Because you don't represent our values. You are not New Yorkers. But maybe the first step should be go down to Palm Beach and see who you can bring back home, because our tax base has been eroded. So I philosophically don't have a problem. It is like I have to look at the fact that we are in competition with other states who have less of a tax burden on their corporations and their individuals. And I would say remote work changed everything. There were people who could only work in an office in Manhattan or work in New York State, and they were captives for a state they were going to stay. We've saw that that's not the case. I mean, Wall Street, businesses looking at Texas, they're not going there because they have a nicer governor. I know that for sure. But they're going there because of the tax rate. We have to be smart about this.
Obviously, that was the clip from 2022 juxtaposed against the clip from just this past week. The one from just this past week, that particular clip didn't include what she said like 30 seconds before, where she said, in New York, we have these very generous social programs, and we are finding we don't have enough tax revenue to be able to fund them. And that's why we should be going down to Florida and asking these people to come back. So this is sort of the very predictable downward slide that socialism has, right? You have these grandiose ideas, everyone thinks, oh, we should do all these things for everybody. And then they realize that, oh, well, to do that, we need to really suck the money from, this productive class. And then that productive class, if they can, then says, well, I'm not going to be your tax donkey forever. And they get up and leave. And then, the state is basically forced with one of two options, which is either, well, we need to find ways to tax people even more, or we need to start reducing our generous social programs. And they definitely don't want to do the latter, or at least until they can. They'll do everything they can to try to avoid that. So you're seeing these ideas getting floated now of, retroactive taxes and, increasing taxes on more of the population. But this is just, this comes as zero surprise to you and I, Lance, correct?
Yeah. Well, no, this is just the basic of capitalism and why this eludes our elected politicians, kind of basic economics 101. Maybe we should have every politician have to pass an economics course before they go to Washington or to state capitals or wherever, because some of the decisions that are made, it's like what mathematical process brought you to this conclusion that this is going to be a good idea, right? And again, this is always the problem. When you take a look at the top 10% of the population, they pay almost 60, 70%, 80% of the taxes. So you're just wanting to continue to take more and more money from the top 10% of income earners. That's fine, but eventually they're going to start trying to figure out other options. And so it's not surprising that a lot of these people have left the state and moved to Florida, moved to Texas. Texas is being overrun right now by companies coming in from other states for a lower tax base, better regulations, better regulatory environment, easier process to do business. We're opening our own NASDAQ stock exchange in Dallas.
Right.
So there's
Y'all Street. Here's what they're going to call
Y'all
it.
Street.
Right?
That's right. And so but that's why. It's money is going to gravitate to where it's most advantageous to work. And look, I get it with younger people. They feel frustrated. They feel like they're, that they can't win in the situation. I wrote that article recently on nihilism. I get it. I get the feelings. I get how you feel and, why you think things are the way they are. But the reality is that we've talked about before, is that the capital system works. You just need to go take advantage of it and make it work for you, not just depend on it to try to give you something, because that's not going to happen. You've got to go out and take from the capitalist system what you want. And that's what people figure out.
Right. Well, and the areas that embrace capitalism, they create jobs. And so if you're feeling frustrated that you don't have the upward mobility you want, maybe go to one of these places where the jobs are more plentiful, and then you can actually become part of a successful, American economic experience. But also, in addition to capitalism, I just want to bring this up here real quick. To me, this is a demonstration of federalism, right? So I think our founding fathers were really smart, and they basically said, hey, look, we should have an overall federal government that kind of tries to do as little as possible. Now, that has metastasized over the years, but that was the original view. And it was like, let's let the states run themselves. And it's basically going to be, an experiment, right? We'll have all these different experiments going on, and we'll let people essentially gravitate to the models that they feel are in their best interests, and the best models over time will win. So, here's a post here on Twitter comparing New York and Florida. So first off, you can see here, New York has much higher taxes than to Florida's zero on income taxes. They have temperature in here, which of course the states can't really do much about, but obviously it's more pleasant generally in Florida on average. But more job openings in Florida. Cost of living index is materially lower there. College tuition is about half the price in Florida. Retirement ranking, I don't know exactly how that's calculated, but Florida is at the top of the list at number 1. New York is almost at the bottom of the list at number 48. And I'm guessing that has a lot to do with cost of living. Annual healthcare costs are materially less expensive in Florida. And what's really interesting about these differentials here is the numbers up here. Florida's state budget is, Florida's state budget is 111 billion. Florida's population is 23.7 million. Now contrast that to New York state budget is 237 billion, and its population is 20 million. So in New York, they basically are spending way more per capita than they are in Florida. Same thing in New York City. New York City's budget is 127 billion. Look at that. New York City's budget is greater than Florida's state budget, right? So again, this is all just, largely just differences in how the states are choosing to be run here. But like as I said,
it's interesting. The budget's bigger than Florida with 1/3 of the population.
Yeah, exactly. With 1/3 of the population of Florida, exactly. So yeah, the expenditure per capita is just crazy, right? So you would think just with those top numbers, oh, in New York, they must be doing great. Everybody who lives there is getting all these, the spending per person is way higher. They should be living a much higher quality of life. Well, they certainly don't seem to by a lot of these key metrics here. And look, I'm not trying just to punch on New York here, folks. What I am trying to say is, hey, look, the the consequences of socialism, history is quite clear on. Lance and I have talked about it an awful lot here, so I'm not going to really rehash that. But this is just evidence, right? Real evidence of where this all ends up. And in many ways, again, we should be really grateful for not just the benefits of capitalism, what they can bring, but for federalism and the wisdom that our founding fathers had to say, hey, look, at no point in time does anybody at the federal government level or at any state level have the right recipe, have the best recipe out there. Instead, what we should do is just make it this ongoing experiment, and we'll learn from each other, and people will gravitate to the models that work best, and that's what we're seeing here in real time.
Yeah, no, exactly. And the way I figure it now is everybody's leaving California. They'll all come to Texas. They'll make California land really cheap, and you and I can move back to California.
Well, so I'm hoping they do that too, and that they jump over Nevada on their way to Texas, so that your state gets spoiled and mine doesn't.
Yeah.
And then, when California gets its own, leader that basically starts running the show a lot better, that'll be the best of both worlds, right? I mean, can you imagine a California that didn't have income tax and oh my God, it would be amazing.
If you could just transport Texas into California, it'd be great. It'd be the weather and the business base. It'd be fantastic. It'd be the world's largest economy.
Well, let's cross our fingers and hope we get there. All right. Well, look, folks. In wrapping up here, if you think the best way to the brightest future for you is to continue watching Lance Roberts on this channel week in and week out, please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like to get some help from one of the professional financial advisors who is on this channel with me week after week in managing your finances for you, whether it's in the short term, given the dynamic that Lance said he's watching closely over the next couple of days, weeks here, or whether it's in the longer term, feel free to meet with them. To do that, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds, and the firms will be in touch with you right away after you fill that form out. Lastly, just a reminder, if you want to get in on the Thoughtful Money Spring Online Conference, if you're watching this when it premieres, you still have time to actually join us for the day. You can do that by going to thoughtfulmoney.com/conference, or you can go to that same URL later on to buy the replay videos of the entire event. Lance, good week, buddy.
Yep.
Interesting times. It's going to be really interesting to see what happens from here. Thank you in advance for tracking it for us on a week-to-week basis going forward. I'll let you have the last word.
Yeah, no, and don't forget, on Monday at realinvestmentadvice.com, I will have the article out on the breaks of 200-day moving averages, historically what happens, and I'll have a whole list of investor protocols about what to do now as we kind of go through this process. So that'll be on the website early Monday morning.
All right, go there on Monday, folks.
Yep.
All right, Lance, thanks so much, buddy. Everybody else? Thanks so much for watching.
In the next handful of months between now and the end of the year, silver is likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. To be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher price of gold. Well, right now, silver's 1.12%. Decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds. 100 to 200 would not surprise me.
Central bank and sovereign demand for silver is rising, supporting higher prices, while COMEX and LBMA delivery activity and ETF redemptions indicate big players are taking physical possession. Analysts view silver as undervalued versus gold and expect a breakout, targeting $60 to $70 by year-end, with potential $100 to $200 plus in a full monetary or credit stress scenario. Risks include unverified accumulation data and uncertain timing of delivery squeezes. Michael Oliver, CEO and founder of Momentum Structural Analysis, argues that measuring silver in dollar terms is almost meaningless. He sees silver potentially reaching $100 to $200 but takes it in stages, personally favoring silver miners over gold. Historically, silver has averaged around 2% of gold's price and even hit 3 to 3.5% in past bull markets, while today it sits at just 1.12%. With silver already up 42% this year versus gold's 37%, technical charts suggest an imminent breakout. Several well-known bullion commentators and dealers' voices like Andy, Bill Holter and Mike Maloney argue the market is now driven by huge physical demand, tightening supply and central bank sovereign buying, conditions that can push silver rapidly higher and make a $60 to $70 year-end print plausible. They point to record COMEX delivery interest, growing central bank interest in silver, and China's physical buying as the catalyst for an imminent breakout. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I think it's really relevant. Yeah, as I said, so many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds. 100 to 200 would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years, and plot it. We have a graph we put in the latest report. 2%, meaning divide an ounce of silver into gold. Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Okay, still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, oh boy, you break through that and I'm going to blow the cork off this thing. The spread is about to do that, I think. And when it does, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals.
Michael Oliver warns that relying too much on fundamentals can mislead investors about timing, like the analysts in The Big Short who were early but not immediately proven right. In 2025, silver has risen 45% so far, hitting about $42 by mid-September. Rising industrial demand for EVs and solar panels, continuous supply shortages of about 800 million ounces since 2021, and growing central bank and investor accumulation through physical holdings and ETFs are the main drivers of its climb. Although supply is static and demand is dominated by China, silver's industrial role is expanding. Nevertheless, until prices compel attention, markets frequently overlook such truths. More significantly, silver has historically been used in conjunction with gold as money. Confidence will crumble as inflation reduces purchasing power and people lose faith in institutions, currencies, and central banks. This transition from optimism to anxiety could be brought on by a declining stock market. Major systemic changes, like the Federal Reserve's demise or income tax reform, are made possible under that setting. That unrest will help silver as an industrial metal and as currency. Let's shift our attention towards the interview.
Well, first off, I don't look at it that much, and I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. Mm-hmm. You could be right and not be right in terms of price reaction for 2 years, okay? You know, do you remember the movie The Big Short?
Yep.
The guy, these 3 or 4 analysts around the country, different guys, didn't know each other, all came up with the same conclusion. There's going to be a mortgage crisis. There's no way around it. They pounded the table, okay? That was 2005, 2006. And it wasn't until late 2007 that the stock market finally topped. And it wasn't until 2008 finally that they said, I was right. So you get the point, fundamentals. Mm-hmm. Okay. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. Annual production of silver is not increasing. It's plateaued and demand is continually increasing. And by the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, which silver is essential. So anyway, that could become a factor where, let's say we cross 50 and CNBC needs an excuse to explain it, okay? And that's a good excuse. Oh, well, the industrial demand, well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows, it has been. In fact, the U.S. has had silver as official money too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt, where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. You suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. As I said, your grandfather, father, and you, house cost, loaf of bread price when I was a kid, it's 52 card pickup. And I think the stock market will be a big key in that. Why? Because right now, if you look at, let's say, the average guy who's got a retirement account, maybe it's through state government pension fund or whatever, if he looks at it nominally and it's been going up, because if it reflects the S&P, then it's been going up. Okay. Not a lot, by the way, over the last year, but, single-digit percent still. It's the only thing he's got to smile at. Everything else in his life is questionable. Cost of things are going up, et cetera, et cetera. And when that goes down, then it's, oh, hell, what's good? All you need then is some layoffs, et cetera, et cetera. And suddenly the average guy, instead of a sense of expectation, is a sense of doubt. And that creates fear. And when you create fear, the tone of markets change. And that's when institutions can get overthrown, ousted, abolished. And so it wouldn't surprise me that in a year or two there's no Federal Reserve. If the economy gets bad enough, which I suspect it will, there may not be any income tax, simply because it doesn't function. They go to a sales tax, etc. All kinds of things can change in big ways. I think that's the kind of situation we're facing now.
As trust in fiat currencies and institutions declines, there is a chance for sharp movements. How much higher may silver's price realistically rise in the upcoming years if it even recovers to 2 to 3% of gold's value? Will a decline in trust in central banks hasten the adoption of silver as a monetary asset and an industrial necessity? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
That we're still at above 2.5%, close to 3% in the U.S. inflation, consumer price acceleration rate, and the interest rate has been being cut since 2024. And you can see gold is rising because of that, or in tandem with that. So now we are in an environment where, first of all, the Fed is going to cut into accelerating consumer prices, and they're going to cut into an accelerating gold price. That was not the case. This is going to be much worse for the dollar, and it is going to be the end of it because the debt is so much higher now. The end game is coming. It is coming soon, and this time is going to be much worse than 1980 for dollar holders and much better for gold and silver holders, because this time the gains of 1980 will be held and exceeded.
U.S. inflation remains near 3% while the Fed continues cutting rates, pushing gold higher alongside rising consumer prices. This policy shift is set to hit the dollar hard, given today's much larger debt levels. Analysts warn that endgame is near, worse for dollar holders than in 1980, but far more rewarding for gold and silver investors, as this time gains are expected to be sustained and even surpassed. Rafi Farber, known as the endgame investor, is a financial writer, investor, and precious metals analyst. Recalls that back in 1980, the Fed fought inflation by targeting monetary aggregates, money supply growth rather than just consumer prices. With debt to GDP at only 32%, they could hike rates aggressively, eventually taming inflation and stabilizing the dollar. Today, however, debt to GDP is near record highs at around 120%, leaving no room for similar rate hikes. Instead, the Fed is cutting rates into rising consumer prices and a rising gold market. Unlike 1980, this environment signals a much weaker dollar and far stronger prospects for gold and silver, with gains expected to surpass those of the past. Remember to hit the bell symbol and subscribe as we begin the videos so you don't miss any updates. If you like the video, Please leave a comment below and give us a thumbs up.
They wanted. The monetary aggregates is the M1, M2, M3 money supply. This is back at the time when the Fed was actually trying to control inflation in a classic sense. Inflation meaning the amount of dollars over the gold supply, how much the monetary aggregates are actually rising. That is inflation in the classic sense, just as they changed the inflation to the effect of inflation, which is the effect on consumer prices, just as they changed the definition of vaccine to what it was before and what it is since COVID. I'm not going to go into that now, but it's the same kind of Orwellian nonsense. But this is back when the Fed actually was not actually fighting inflation, but trying to control inflation, meaning the actual monetary aggregates, the money supply numbers, not the effect on prices. They didn't care, not that they didn't care. It wasn't their primary goal to change the effect of prices, of consumer prices. They knew that if they attacked the monetary aggregates and controlled the expansion of the monetary aggregates, they would, by extension, control consumer prices, which they did in the end, which is why we still have a monetary system as it was in 1980. So basically, at this point, the Fed is jacking up interest rates in order to control monetary aggregates. And we can see here by this chart, when they hike into the maximum, exactly when this is, I think this is early 1981 or something like that, once they see that the monetary aggregates are within the growth ranges that they prescribe, then they get control over consumer prices over here in the red, and they get control over the gold price, but this is, of course, not their primary goal. They want to control the monetary aggregates, which will control the consumer prices, which will also control the gold price by extension, and then they start cutting rates once they see that this is under control. The other reason why this is not a 1980 situation is that you can see the debt to GDP ratio. I know GDP is fake, but this is still a general relative number that does convey some information. The debt to GDP ratio in 1981, when interest rates were at a maximum, was 31.8%. This is, I think, an all-time low since Andrew Jackson, maybe. Maybe I'm exaggerating that. I didn't look into the 19th century. I can't find statistics for debt to GDP ratio in the 1800s, but you can see that this is the lowest debt to GDP ratio. This is precisely when gold was topping and when inflation, consumer price inflation, was topping out. This is why they could jack up interest rates so high, because the debt was so low by comparison to any other year from World War II, at least before World War II, the Great Depression, until now. That is why 1980, the dollar survived that turbulence. But now, of course, we are at 120% or whatever it is, the very, very near an all-time high in debt to GDP. There's no way that they can raise interest rates now, which is why they're cutting it, and they're cutting it into rising consumer prices. You can see here, this is the chart of the interplay between the U.S. inflation rate. Inflation, I mean in quotes, not really the inflation rate, but the consumer price acceleration rate. And gold you have here, I don't know why it's not in gold. What is that, gray or green or whatever the hell it is? And you have here the blue U.S. interest rate, the federal funds rate, and you can see here that we're still at above 2.5%, close to 3% in the U.S. inflation consumer price acceleration rate, and the interest rate has been being cut since 2024. And you can see gold is rising because of that, or in tandem with that. So now we are in an environment where, first of all, the Fed is going to cut into accelerating consumer prices, and they're going to cut into an accelerating gold price. That was not the case in 1980 at all. So people that say you can't compare to 1980, this is not that situation, stop using those ratios, I agree. This is going to be much worse for the dollar, and it is going to be the end of it, because the debt is so much higher now. And unlike 1980, when they were cutting into a falling consumer price inflation environment, now they will be cutting into a rising consumer price inflation environment. And while debt to GDP was so much lower in 1980, it was lower than any time before World War II since the Great Depression. Now it is at an all-time high. There is nothing they can do. They have to cut into rising consumer prices because the debt is so high. Where in 1980, they didn't have to do that, and that's why they saved the dollar, and that's why they will not this time. So forget about the Hunt brothers. The end game is coming. It is coming soon, and this time is going to be much worse than 1980 for dollar holders, and much better for gold and silver holders, because this time the gains of 1980 will be held and exceeded.
Rafi Farber points out that in 1980 and 81, U.S. inflation and gold prices were surging while the Fed raised interest rates aggressively to regain control. After briefly cutting rates, they were forced to hike again up to nearly 15%, when money supply growth ran hotter than expected. Only once inflation consistently declined did the Fed start cutting rates steadily, which helped stabilize the system and prevented the collapse of the fiat dollar. Now let's review the interview.
And so here we have a chart with three colors, blue, red, and some kind of yellowish, greenish, orange, whatever blah that is. You can tell me later in the comments how stupid I am at colors, but whatever. My eyeballs are my eyeballs. What can I do? So this one, which I think is the red one, is the U.S. inflation rate. This one, the blue one, is the gold price. It's not exact. And this one over here, this wobbly one is going down over here, and then back up. Blah, blah, blah. That is U.S. interest rate, meaning the Fed funds rate. Now, what was going on here in 1980? What was going on was that interest rates were going up and up and up and up because the U.S. inflation rate, the inflation in quotes, the inflation rate, meaning consumer prices were rising, they were rising and rising and rising, and so the Fed was raising and raising interest rates, but not quite. We'll go into why not quite. That's not what was happening in the next slide. This was a situation where interest rates are rising, gold was rising, the inflation rate, the consumer price inflation rate was rising. And then you have this period here where they were cut, the interest rates were cut back down here to whatever that is, I think 5%. And then they were jacked right back up to about 13, 14% right here. And we'll see exactly why this was in a second. But you can see here that the Fed was trying to quash consumer prices, not exactly consumer prices, we'll see why in a second. They were trying to quash something else. And as they were doing that, finally, when they got control of the U.S. inflation rate, when the red line started going down, that is when they consistently started cutting rates over here in this greenish, yellowish, whatever line that is. And you can see here that the gold price was falling with it as well. What I'm trying to say here is that back in 1980 and 1981, the Fed was raising rates, trying to quash consumer prices, and only once they accomplished this goal and they saw that the inflation rate was falling consistently, only then in 1981 did they start cutting rates on a consistent basis as consumer price inflation was falling, as the acceleration in consumer prices were falling. So in other words, the Fed already had control of the inflation rate when they started cutting on a consistent basis. That's what happened in 1980, and that is why, one of the reasons why, the fiat monetary system did not end in that year. This is not really a chart. This is a transcript. I will give you the link in the description below as to exactly where you can find this thing, and it's on page 7 of the PDF that I found it on at the Federal Reserve's website. This is to a staff analysis, says the Federal Reserve Board. The demand for money had been quite strong in recent months because of recovery in economic activity and in nominal GNP, not GDP, GNP, slightly different, had been much larger than anticipated. Growth of transaction balances was projected to slow significantly over the remainder of the year, in part because of the lagged effect on the demand for money or the sharp rise in interest rates over recent months, and in part because of the apparent weakening of the recovery in activity. In the committee's discussion of policy for the period immediately ahead, the members generally favored pursuit of a sharp reduction in monetary expansion from the rapid pace of recent months. And so, if we go back to this chart over here, this is November of 1980 when they started to raise rates again after cutting them over here. This is 1980s around here where I'm circling when they started to raise rates back up to the maximum around 15%. Why did they do that? Because they saw that the monetary aggregates were rising at a faster pace.
Unlike 1980, when the Fed had the flexibility to crush inflation with aggressive hikes, today's debt-heavy environment leaves policymakers with fewer tools. Cutting rates into rising inflation risks undermining the dollar while fueling gold and silver to new heights, suggesting this cycle could deliver far more lasting gains for precious metals. Could today's debt levels make it impossible for the Fed to repeat the 1980 playbook? How high might gold and silver climb if the dollar continues to weaken under current policies? Please feel free to leave a remark below with your thoughts. Please give this informative video a thumbs up and subscribe to receive our most recent updates. Thank you for joining us on this trip.
China is buying gold like crazy. The people in China are buying gold. They love gold. And the central bank is also buying gold on a consistent monthly basis, basically. China is the largest gold producer already, and they consistently buy more gold. They use this, of course, as a way also to attack America, because gold is the antidote to the American fiat dollar money system. And they plan to build gold vaults in many other countries. Gold is clearly in a secular bull market. The only caveat would be if we see gold now really accelerating dramatically over the next few months and maybe 1-2 years, doubling in price immediately and running to maybe 8,000-9,000 in the next 1 or 2 years, then it would probably have the characteristics of more of a bubble, and we would have to be careful. But if it's just pushing higher like it's been doing now the last 14 months, I think it's very healthy, it's very sustainable.
China is both the largest gold producer and a heavy buyer, with its people and central bank consistently accumulating gold as a hedge against the US dollar. China is building vaults abroad to back trade in yuan with gold, challenging the dollar system. China's central bank has increased its holdings of gold for 10 months in a row, ending in August 2025. Their gold reserves rose to about 74.02 million fine troy ounces. Gold is in a long-term bull market, and while a sudden surge to $8,000 to $9,000 within a year or two could signal a bubble, the current steady rise looks healthy and sustainable, pointing to much higher prices ahead. Florian Grimmies, a precious metals and cryptocurrency analyst and investor, highlights that central banks in China, Russia, and India are buying gold instead of Bitcoin, while the US is pushing into digital assets to maintain dominance, raising concerns about surveillance and sustainability. A World Gold Council survey shows 76% of central banks expect to raise gold reserves in the next 5 years. China has boosted its gold reserves for 10 straight months, joining Russia and India in favoring gold over Bitcoin, which remains too volatile and unrecognized as a reserve asset. Rising stagflation risks, low growth plus high inflation, are driving demand for hedges like gold and real estate. Analysts warn that while gold's inflation-adjusted price is at record highs, steady demand could lift it toward $3,700 to $4,000 per ounce by 2026. Tracking wealth in gold or Bitcoin, rather than just dollars, shows how purchasing power continues to decline. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
The Chinese, the Russian, and the Indian central bank are buying gold and not Bitcoin. The Americans desperately need something new to continue basically running their hegemony, and apparently they decided it's going to be the digital asset space. It makes sense to a certain level. At the same time, a digital dollar as a stable coin is just really much better. No, it's not. I mean, I'm very much worried about the whole surveillance kind of thing. I'm not sure if Trump himself really understands the whole thing. I think he has a lot of advisors who are telling him what to do and what to say, but if he really understood it, I don't know. It probably is the last chance that America can do, because they are not having enough gold.
You know, it's interesting. I read recently that Trump's assets, his corporate and family assets, have shifted from real estate predominantly to now crypto and Bitcoin predominantly.
Of course, it's amazing. I mean, who would have thought that, right? A year ago. To a certain extent, I would say yes. I mean, I think, first of all, the Trump family just wants to make as much money as possible.
Sure, okay.
So that's, I think, the major intent here. And I think it's very questionable what's going on here. Very questionable. But at the same time, of course, I mean, the administration before was also extremely questionable because they were completely against it. Yeah. Didn't allow any invention here and progress. So I at least that's what I appreciate now with Trump. But I think it's a turbo casino capitalism kind of style here. And Trump makes sure that his family makes a fortune here. And anything else, I don't know. Is it really better? I mean, yes, they create more demand for US treasuries if people buy more Tether, and then this is getting converted into the crypto market. Yeah, okay, but is this really sustainable? I don't know. I mean, The whole thing is more and more questionable in my opinion. Yeah, exactly. That's what's going on. On the one hand, massive expansion of the money supply, and not only in America, all over the world. If you look at these numbers for the European Union, if you look on Japan, on China, everyone is basically printing money. And on the other hand, the consumers are losing the confidence in these currencies, in these fiat currencies, because they see that they have less and less purchasing power. And so people are trying to escape into hard assets. And that's why, at the end of the day, real estate is still holding up rather well. Okay, there is regional differences, but overall, it's holding up well. And in many areas, actually, real estate is still getting more expensive. Your stock market overall, even though there's lots of questionable things happening in the economy, and you see that basically a stagflationary kind of scenario, the stock market is higher because people buy these stocks as a hard asset, so to speak, moving their money out of the fiat world. And gold, precious metals, mining stocks are moving higher, and crypto as well. And even your rare stamps and your old timers are getting more expensive because the fiat money is losing purchasing power and people losing confidence. I mean, you can see it in many countries. The society is becoming rather unstable. Some of them are actually close to a civil war. These are all the consequences out of it, and this is just continuing. I don't see a turnaround. It basically says that on the one hand, central banks, politicians, increasing the fiat money supply, basically printing money out of thin air, and on the other hand, consumers and participants in these financial systems are losing the confidence because they can see that the purchasing power of their fiat currencies is diminishing by the day in the end of the day. And that's basically happening at the same time. And what it means is your assets or your investments can go up on a nominal basis, while in real terms they haven't moved at all. But people only look at the value of their assets in nominal terms, meaning in dollar. I mean, how many people are actually looking or calculating their net worth in Bitcoin and in gold ounces? It gives you a totally different picture over a 5 or 10 year time frame than just looking at it in terms of how many US dollars am I in total, or how many euros or Canadian dollars, right? So I'm doing this as a little homework every 4 months, updating a little Excel sheet, tracking my net worth, and you can see how challenging it can be actually to keep up in terms of Bitcoin and gold with your total net worth. You know, you might have more euros or dollars, but not more Bitcoin and gold.
Florian recalls, in 2022, when the Fed hiked rates, Bitcoin crashed, and gold dipped but held much stronger as a safe haven anchor. Since its triple low 3 years ago, gold has risen over 130%, supported by 4 key drivers: expanding global money supply, the bond bear market pushing institutions toward gold, massive central bank buying since sanctions on Russia, and China's relentless gold accumulation for both citizens and reserves. China, already the largest producer, is building vaults abroad to back trade in yuan with gold, challenging the dollar system. This shift is unwinding decades of paper gold price manipulation, as physical demand now drives the market. Beijing is also making gold imports/exports easier. It's seeking feedback on streamlining licensing processes, longer valid licenses, more customs offices authorized, to smooth gold trade. China's consistent accumulation supports the idea that demand from major sovereigns is backing gold's secular bull market. The fact that China is pushing through regulatory/reform steps for gold import licensing underscores a long-term strategy rather than a short-term bet. Central banks globally continue with strong, steady gold purchases in the face of geopolitical risk, inflation, and concerns about U.S. dollar reserve dependency.
First of all, in that 2022, when the Fed started hiking interest rates and everything came under pressure, Bitcoin went down to $15,800 from $69,000, and gold came down to $16,15 from 2070-ish. And had a triple low, more or less 3 years ago. But gold held up much better during that time than everything else. So I remember being very happy having a large chunk of my portfolio in physical gold, because it basically stabilized and was rather in a safe haven anchor in that time when everything else was plummeting. So since then, yeah, gold is up 130% since that triple low 3 years ago. And you asked for the driver. So in my presentation yesterday in the morning here at the conference, I presented my take on it. I think there's 4 big, very important macro drivers for gold. The first one, I mentioned it before already, M2, money supply, the liquidity basically in the system, constantly being expanded over the last few years, and especially now again in the last few months. And not only in America, but also in the Eurozone, in Japan, in China, wherever you go, basically. If you would look at South Africa or Brazil, you would basically see similar numbers. So liquidity expansion. Second big driver is the bear market in bonds, especially in the long-term bonds. So the long end of the bond market, I think the Fed has lost control over it already. We have still a rather persistent inflation. And if you're an institutional investor and you have to seek safe, conservative, long-term bonds, and now you are in a bear market in bonds, it's very challenging. So I assume more and more institutional money will go into gold because it's the only other asset that they can buy. So that's the second driver. The third driver is central bank buying. We haven't seen that in like decades, that strong demand from central banks. Of course, it increased dramatically since Russia invaded Ukraine, when the whole world realized, like, whoa, the Americans, NATO, the Europeans just can confiscate our assets whenever, however they want. So now lots of emerging market central banks and nations are trying to diversify themselves out of the dollar, out of the euro, de-dollarization. Central banks are buying gold. They don't chase gold, but they also don't really care about $100, $200. So that's exactly what we've seen over the last 14 months. Whenever there was a consolidation in gold, you didn't really have a big pullback because very quickly physical demand showed up in the market again. And the last one, which is also very important, probably the most important besides the central banks, is China. China is buying gold like crazy. The people in China are buying gold. They love gold. And the central bank is also buying gold on a consistent monthly basis, basically. China is the largest gold producer already, and they consistently buy more gold. They use this, of course, as a way also to attack America, because gold is the antidote to the American fiat dollar money system. And they plan to build gold vaults in many other countries. Yeah. So if they do their trade business with Saudi Arabia and they buy the oil from the Saudis, they will give them the renminbi, and the Saudis can take these renminbis, go in their own country, go to the vault, here's the paper renminbi, show me the gold. And I mean, this is what the Chinese are working on, to inject confidence into their yuan kind of system, building an alternative system to the US dollar system. And that's not going away. Those 4 drivers that I just mentioned, I mean, they're going to be around for the next 1, 2, 3 years at least. It could maybe take a decade or even longer until this fully plays out. And I think during that time, gold will be strongly supported. There will be strong physical demand. And out of the consequences also out of those 4 drivers is that you are seeing now the unwinding of that 50-plus decade Anglo-Saxon paper gold Ponzi scheme kind of system, right? Yeah. So we know that in the past 5 decades, the price making or the price finding for gold has been dominated by trading 200 paper ounces of gold for 1 real ounce of gold. That's how mainly the price finding has basically happened. And this is being unwinded now. And this can take a long time. And again, I just mentioned it before, gold is super strong, no real pullbacks here, no dips, people chasing, running behind the train. It just pushes higher, and whenever there is a dip, immediately big hands showing up with physical demand. And I think it's super bullish. Gold is clearly in a secular bull market. I think the price targets that you and I were talking about 5 years, around $9,000, if you remember. Yeah. I think that's still the case. We probably have to revise them, and it's probably gonna go even higher. The only caveat would be if we see gold now really accelerating dramatically over the next few months and maybe 1-2 years, doubling in price immediately and running to maybe 8,000-9,000 in the next 1 or 2 years, then it would probably have the characteristics of more of a bubble, and we would have to be careful. But if it's just pushing higher like it's been doing now the last 14 months, I think it's very healthy, it's very sustainable, and we're going to see much higher prices. And this can last for at least a few more years, at least.
Could China's gold-backed trade strategy accelerate the decline of dollar dominance in global finance? How might central bank gold buying continue to influence prices compared to private or retail demand? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, thank you for being with us, and wait for the next updates.